Hello, 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 and welcome back to King Pilled. This is Matt. The weird-looking guy is Cooper, and our guest today is
The other
Mr. Sean
weird-looking guy.
Wieland.
I was going to say, thanks for not making me the weird looking guy.
It is good to be back here. I think you guys are really going to enjoy this episode. Our good friend of the show, Jay Burden, hit me up a couple weeks ago and said, "Hey, I've got this guy who's a legit genius. You guys should have a conversation." And I was like, "Well, that's definitely setting the bar high." And somehow he managed to clear the bar in the conversation. That
I was going to say, I think I'm going to disprove that, but
so we're going to get into some probably more technical, I guess, economic analysis of stuff today. But Sean has some very interesting ideas that I think they square very well with a lot of stuff that we've been talking about lately. So if this is your guys' first time watching, please like the stream. If you're listening on the podcast later on, then subscribe to the show and leave us a rating and review. That very much helps with what we're doing. And for those of you who don't know, in case you've missed it, I did a conversation with Orrin McIntyre on his show yesterday talking about the PayPal mafia. I am apparently now the, I guess what's the word? The hagiographer of the PayPal mafia. That seems to be the lot that I've drawn. But anyways, so thank you, Sean, for being here. Let the fine people know who you are, what your expertise is, and then, like I told you before, go ahead and take the floor and run with it.
yeah, thank you very much for letting me be here. So my background is I own a wealth management firm. Been doing wealth management for about almost 15 years now. Specializing in exit planning. So a lot of the generation conversation that you've been having, particularly the fact, similar to kind of Tim Dillon as well, that boomers have a death grip and will die with their capital like the pharaohs of old, has been an issue. And it directly affects my business that everybody was expecting this silver tsunami of, hey, okay, boomers are in the 60s, 70s, 80s. Maybe they need to sell it to the next generation, actually extract some value out of the businesses they've built, and they're just straight up not doing that. That led me into a real rabbit hole of kind of the history of public markets versus private. Again, this has been my wheelhouse for some time. And where this really started to intersect with the dissident right is the history of publicly traded stock. I think, it's kind of the like the two fish saying, what's water? We're kind of born into this world of, oh, well, of course you have a 401k and an IRA and, you're going to own these stocks and save for retirement. But it's actually a relatively recent thing. It's what's been able to bootstrap the managerial revolution. Along the way, there's been some interesting developments as far as looking how, for instance, how Michael Milken developed the junk bond market as a way to raise capital when the existing corporate interests really did not. They wanted a control on people's ability to do that. We've sort of seen a rehash of that with crypto and some parallels there. And then also just generationally, that there's a liquidity trap with boomers that no, I'm all over the place. It'll give us material to get into that, as Nixon closed the gold window in 71 and then ERISA passed in 74. It's also when the NASDAQ opened in 74 that it was designed in many ways just to absorb the inflation that was being produced during the stagflation era, which has created an asset bubble. Asset bubbles crowd out real profitable businesses or real capex, basically. And now there's also a demographic crisis on top of that. The boomers are retiring. They're selling in order to generate income rather than purchasing. And there's really nobody on the other side of that trade to buy out their position. So there's kind of a perfect storm of events going on here that is very directly relevant to a lot of the issues that we're dealing with, as well as just ones that my own firm has to grapple with on a daily basis.
Excellent. That is, you basically, from everything that we talked about before, you basically summarized all of that in a couple of sentences. So now we're going to go through and we're basically dig down into each of these little points that you brought up and how they all connect together. So one of the first things that you led with when we started talking, and then when you emailed me earlier today, was you used the phrase "publicly traded stock is what funded the managerial revolution." So can you break that down for us?
Yeah. So this is what my forthcoming book is going to be on. So that really began with Woodrow Wilson, World War I. There was a movement at the time, that progressive era of seeing the so-called robber barons acting as, equity lords, and their desire to undermine that, their perception of democracy or egalitarianism or what have you. And the way that kind of the MBA crowd was able to seize control of these large corporations from their legitimate owners was through publicly traded stock. Now, first, that actually came about by funding World War I. Getting into World War I caused a command economy, which got them one step closer to the socialism of being managed by an enlightened group of experts as opposed to the owners. The way that was done was using Liberty bonds. We still live with the ramifications of the laws that created Liberty bonds to begin with. Every time you hear about hitting the deficit ceiling and the need to raise a deficit ceiling in order to issue more bonds in order to cover the ever-expanding debt, that's all from that original law. That's actually how we got that sovereign debt or treasuries to begin with. In order to convince regular people to buy them, when this was done as kind of a beta version of this during the Civil War, they were sold to Europe. But by the time World War I rolled around and Europe was in the middle of a war, they had to find a way to get the what we now call the retail market to buy them. So they reached out to some New York financiers who were very good at peddling these sorts of things, basically created the retail market. And then after World War I had wrapped up, of course, that's when corporations realized they could get in on the same game. And really, they're participating because they're the same people. So that's how we got the Roaring '20s. I think everyone pretty much understands what happened by 1929 and how that system collapsed. We got another World War. And then coming out of that, between Woodrow Wilson and then FDR's New Deal, we really kind of solidified that managerial revolution. And corporations had taken over, and the owners are basically anesthetized from any interest in their company once they see that stock always goes up and to the right. I mean, think of you think the owners of NVIDIA are very worried about what's happening with their company, but the managers who are in there, they're there for a limited amount of time. They're going to get their golden parachute. They don't really have any long-term interest. So it's treated much more exactly like the administrative state is, or like the nomenclature in the Soviet Union. In fact, there's a lot of parallels between how the Soviet Union was operating and this system. But just like managerialism is the soft version of communism, going public or publicly traded stock, we really have to think of that as kind of like the soft version of nationalism. That basically what's happening is a stock swap. And there's an argument that when we think of fiat currency, it's really much more like sovereign issued stock than it is like a bond or like commodities. That's something that both Curtis Yarvin, of course, famously has put out. And then another analyst who I'm a huge fan of, Mike Green, who is also was patronized by Peter Thiel. He was originally working for Peter Thiel's family office. So I don't know if this is actually Peter Thiel's idea and it just kind of trickled down separately to them, or whether just two smart people came to the same conclusion. But IPOs for the longest time were the only way that anybody really became in America received like an aristocratic level of wealth. And it really wasn't until Michael Milken in the 80s that he kind of circumvented that phenomenon. And the people were the power brokers at the time were not very pleased with that. That's kind of how Ivan Boesky was coerced into throwing him under the bus until Trump pardoned him 5-6 years ago. But so that's the thing about publicly traded stock. And then the thing about that is so over time, originally stock before then was really dividend focused. There was no gap accounting or really any way to look in the book. So really what people use is the dividends that a company paid as the bellwether for whether a company was legitimate or not. Like somehow they're paying their bills and able to pay the shareholders a dividend, so they must be doing something right, was kind of the idea. But then as soon as you get into post-World War II, the nifty 50s, the design and central banking is kind of the dovetail with this, is the need for dividends reduces less and less, and there's much more emphasis on capital appreciation. And in fact, the tax advantages of dividends were eliminated in a tax law change that happened in the 70s. And then, of course, in the 90s, you got the tax break for capital gain, long-term capital gains. So the system is slowly incremented towards this asset bubble speculation, which has eroded into dividends, profitability, and any kind of like genuine price discovery. And that's a big part of just how the managerial revolution has been able to lock in that control. Not having to pay dividends is also very helpful for these, the C-suite as well, because if they don't actually have to pay out profitability and they're supposedly reinvesting that in the firm, Okay, they're doing that, but they're opening up other departments, more administration. Basically, they're getting allies within their business in order to protect their position on the board or as management, as opposed to it really primarily being profit driven. And then, they're going to the same, Wharton or the same or Stanford, the same schools with the same people in the administrative state. And there's also a lot of collusion as far as, okay, and now we've really seen it with the COVID phenomenon, that as long as they're towing the line politically, they're going to get access to lines of credit in order to do stock buybacks. Buybacks were also legalized relatively recently. And so their earnings per share and all that, again, basically stock price goes up and to the right and nobody questions the decision making as long as that continues to happen. But something like 30% of companies out there, what are called zombie capital, like they haven't been profitable in over a decade. They're just lurching along on credit because there's any need for market discipline has been completely eviscerated from the process.
So essentially what you're laying out here is like managerialism's war on the profit mechanism, because capital appreciation, if companies are being valued along the lines of capital appreciation, that's a number that can be easily gamed. So it can be detached from the actual facts on the ground, because now you've veered into a multivariate, subjective thing relative to how people value a particular thing, and that sort of thing can be gamed and weaponized.
Yeah, and then what really compounds that as well is the rise of indexing. This idea that, well, in the long run, stocks go up and to the right. It's gamed that way. So why bother doing market research? Why bother paying fees to analysts to figure out good companies from bad? You're just going to buy the index because it's cheap. Now that takes basically the shock absorbers out of the whole system, and again ties everything to just that capital appreciation. Worse is now basically everybody is buying into the same index, and even active managers, because they're benchmarked to that same index, become closet indexers. So their own professional risk or career risk is not going to survive being below whatever the index is for more than a couple quarters. So they're never going to take big risks or long-term looks at investments. They're going to mirror the whatever they're benchmarked to pretty closely. Even official indexing, I'm pretty sure, is over 50% of markets now. And then with the closet indexers on top of that, basically everybody's synchronized. And the danger there is, boomers have put their whole retirement into this. When ERISA was first passed, it was meant to be a supplement in addition to pensions and Social Security. Pensions quickly went away. Everybody was completely enamored with the stock market in the 80s and 90s because of this asset bubble phenomenon. It went from a place to preserve your purchasing power to, for a while, I think now, the younger generations kind of forget this after the 2008 financial crisis, but especially in the 80s, 90s, and even the 2000s, it wasn't even so much of, I'm going to invest in the market to maintain my purchasing power, as like the market's going to make me rich, that somehow I'm going to buy into the beta of the market and it's going to take care of my retirement for me. And a lot of the retirement rules that came out of that, like the 4% rule, were kind of tied to that. That now they've had to revise that down to, I believe it's below 3%. And there's a whole issue with that. There's all kinds of issues with modern portfolio theory of how most advisors out there are assessing risk and communicating that to investors of publicly traded securities. But yeah, so the issue then is, especially the younger generations, they grew up in the shadow of that 2008 crisis. They think there's what's called fiscal nihilism, this sense that, well, the Wall Street is a casino. Why would I ever seriously invest in this? And people forget that it is a market. There has to be market makers that match buyers and sellers, just like eBay, for example. And if the boomers all need to sell because they're reaching an age where they have to sell to generate retirement income, and they've been sold this modern portfolio theory idea of, well, you're going to sell off a little bit of that capital appreciation in order to generate 4%, in order to have income in your retirement. And they can't sell because the younger generations think it's a scam and won't buy. And the younger generations too, they've basically seen all these asset bubbles be at all-time highs relatively too, right? Whether it's housing stock or the stock market. Why would you buy in at a high anticipating that we're probably going to see another crash, and then it's the younger generations that are supposedly going to be left holding the bag? I think they're all very sour on that idea as kind of like a generational trauma, as much as that word trauma gets overused. So there's a real liquidity crisis, right? You've got indexing that has completely taken the shock absorbers off of things. You've got the demography of boomers getting older and needing to sell to generate their retirement income. And then the younger generation's not really being interested in buying. And this whole thing is a social experiment that began with the boomers in the 70s. Like, we've never gone through a full cycle of this. And just like, you know, people talk about Social Security not being there when they reach retirement age. And I think by like the 2030s, if nothing else changes, they're going to have to cut the income that gets paid out from Social Security by like 25%. Even more so with this asset bubble in publicly traded securities. It was great for the managerial revolution and getting the C-suite and the MBA people into positions of power and getting the owners to stop giving a shit about their own companies. But now that we're at the point that, like, hey, the check's got to get paid, something's going to give. And we actually saw exactly the same thing with the Soviet Union. They had a massive inflation problem after World War II. And it was more of a command economy there. They basically forced all the workers to buy their version of like sovereign bonds or sort of like government CDs, saying, okay, and, you know, there's almost no investment options available under communism. So they're kind of promised, hey, you know, we're taking some of your paycheck now, but don't worry, you know, 20 years from now, it's going to mature and you're going to get a higher interest rate than you would get, you know, in the People's Bank or whatever it was. Now, of course, by the time those came due, they revalued the ruble and basically wiped out anything that they were going to pay out. So there's a precedent for trying to make this work, getting to the point that they have to actually meet these obligations. And then when it comes time to pay the piper, they can't do it.
Okay, so as I'm distilling this is one of the most densely informative presentations on stuff like this I've ever heard.
Yep.
As I'm distilling this down, so you have a war on profit, and that operates through the killing the profit mechanism, and then on its heels, and maybe as one with it, comes a war on risk, where the market moves away from risk-taking behavior, actual genuine skin in the game, to where you have these closet indexers who they're becoming managers themselves. They are taking on the mentality of the managerial class, and they're just functioning as, they don't have personal skin in the game. They're outsourcing the risk-making part of their business to someone else, and everyone's all doing this around together. So you could almost see it as like the stock market being a company going through the life cycle of a company, where a company starts out with big bets, a big risk as a startup. The people, the founders, are directly invested. They've got skin in the game. They build up this managerial system, and then, like a company does, it hits its peak, and then eventually it starts falling into bad habits, and those bad habits typically are manifestations of the managerial personality itself. No longer risk-taking, et cetera, et cetera.
You get the principal agent problem, right? That what's the interest of the managers is not what's the interest of the company. And the interest of the managers know they're only going to be there for a temporary amount of time. So they're going to make decisions with the office that is not in the best interest of the office, but is going to help them secure their job until they're going to leave the position. And then whatever happens to the company after that point, they don't really care. And same thing with, if you look at like the nomenclature in the Soviet Union, right? If they're running, the Department of Fisheries or something, they're just using that to collect bribes and, get people jobs and do, patronage and favor trading. But they're not actually interested in whether the fishermen are doing a good job, or whether the price of fish is going down through more efficient methods or whatever. Like any actual efficiency of capital structure, nobody cares. The goal is just to keep that share price high, prevent it from falling too much, and reducing volatility. You also hit a point there. Chris Cole is another one of my financial analyst heroes, and he's big on that volatility cannot be created or destroyed. It can merely be transmuted. And you just see this in the more that volatility is suppressed, the more it's going to pop up in unexpected places later.
That just is like a law of physics. That's a really fundamental reality. What you're describing sounds to me like, are you familiar with this term, Parnell's iron law of bureaucracy?
Right. Yeah. So that's exactly what's going on. Yep.
Yeah. Where you have every bureaucratic institution will inevitably split into two parts. One group of people who exist for the purpose that the bureaucracy ostensibly exists for, and one group of people who exist for the sake of the bureaucracy itself.
Which is exactly what we saw, especially during the lockdowns, between large publicly traded companies and then small business. Carol Roth wrote a great book, The War on Small Business, and that's exactly what it was. Okay, we have to clear out these other people who are giving away the fact that, you know, we're not doing price discovery and nothing about this is efficient, because that's going to give away the game. So if we get rid of them and can maintain this, you know, suspension of reality bubble, then we can keep this thing going. It's also a big part of, you know, Peter Thiel and Tyler Cohen have that idea of the great stagnation, kind of like what, you know, or even what Mark Fisher and Nick Land, the slow cancellation of the future. Like, why does it still feel like the 1990s were last decade, right? Like, have we really seen culture? I mean, we have faster internet and the smartphones are better. But besides that, like, nothing really, it's not that much. I know people are probably going to say AI or something. I'm kind of an AI skeptic. But besides that, it's like, okay, we have like these marginal improvements on things that were developed decades ago, but we don't have any of the revolutionary things like transistor technology that we had that kind of got us out of that rut in the 70s, 80s, 90s, right? And I think that's the reason for it, is that, yeah, because they're more focused on, well, we just got to keep going the same direction, and they've busted the compass that we've used to find the North Star to know what the right direction is. Then nobody can be wrong about, you know, you could be going in a circle and it still seems like you're getting somewhere. And I think that's, or like that Russian joke about during the Brezhnev era of being on the train and, well, we're just going to close the windows and pretend we're still moving. We've created exactly the same thing, except through a different mechanism.
So what are the, yeah. What are the, I guess run us through then the consequences of this. What is this detachment from reality? I mean, eventually reality is going to come back around to bite us in the ass. So what do you think that's going to look like?
Yeah. So, right. So, and I think we're seeing it now with the competency crisis, likely shortages of real goods, that like just the system will not be coordinated enough to take care of the things that people need, because nobody is going to be functional in the system. And, you know, in the Soviet Union, that eventually gave way to Gorbachev and the bread lines in the 1980s. You know, predicting the future is a little dangerous because I'm going to be wrong no matter what. But
I've been learning this. I've been learning that the other thing that happens when you do anything that even remotely resembles predicting the future is a whole bunch of people get mad and yell at you about it.
Yeah. So people are probably going to be mad about this as well. I can say that if history rhymes at all, how we looked at what happened in 2008 with the mortgage-backed securities, and unlike the Bank of Japan, the Federal Reserve Federal Reserve is unable to directly buy securities to try to prevent that kind of conflict of interest. But with mortgage-backed securities, and in an emergency, right? So you have what's his name, who wrote The Myth of Rule of Law, or even Carl Schmitt and the idea of, you know, sovereign is he who sets the exception, is, you know, in a crisis, you know, the law doesn't matter, right? So during 2008, the Fed could not own mortgage-backed securities directly. So they just created a special purpose vehicle, Maiden Lane Transactions LLC, and that was sponsored by the government, so that was okay to own. And then that was the thing that went out and bought mortgage-backed securities, and they did a gated sell-off through that. So it would not surprise me if boomers, as the largest, most politically influential, you know, the ones who control all the capital generation, some kind of gated sell-off is proposed once a real liquidity crisis hits. So the danger is you're very much at risk of something called a liquidity cascade, which is kind of like a cascade failure of everybody's trying to sell off at the same time, and, you know, it's not it's like a distributed conspiracy, kind of like the cathedral concept, that everybody's kind of trying to do the same thing at the same time, even though it's not a centrally coordinated action. And as a result, in order to prevent prices from plummeting, you're going to get kind of, again, this quasi-nationalization of probably something like a promise of, you know, okay, boomers, well, we'll let you get access up to 10% of your capital per year in order to generate retirement income, but not more than that, because we have to keep the prices up. I think there'll be some kind of intervention that will prevent an actual fire sale in assets. I mean, if there's anything we've kind of learned from the past 30 years, is that you know, a natural market correction is never tolerated. There's always some kind of government intervention in order to protect the people who are actually holding those assets, whether it's, you know, these index funds or commercial real estate, or any place where those people's wealth is tied up in a notional value.
This is really interesting. It's I'm seeing this pattern around a whole bunch of different aspects of the regime where they bury everything in abstractions and complexity. And I think this is probably a feature of living under like Pareto's Fox regime. That everything gets abstracted away, everything gets buried in complexity. I mean, so sovereign is he who decides the exception. So in the time of crisis, the sovereign steps in and decides the exception, but even then, he doesn't decide the exception by saying, "All right, well, the Fed's just going to do this thing." It's like, "Oh, well, no, the Fed is going to set up this other organization, and we're going to call that organization private." And you work the whole thing through, and
because public opinion still matters to some degree. So we saw this
Right.
with the 2008 financial crisis. Another theory of Mike Green, which I think is very fascinating, and he has the receipts and research on this, is and actually, who was it? Some other people in our circle have been interviewed on this recently and have kind of touched on the same things. But, we were sold this idea that it was to bail out the homeowners, right? And that's kind of what it took to get the political will of TARP put through. But more money went to bailing out foreign banks and correspondence banks as part of the Eurodollar regime than to bailing out homeowners or mortgage-backed securities in the United States. So
that's really interesting to me. I didn't know that.
He looked into this. He thinks really the tipping point was Hurricane Katrina wiping out the oil refining capacity in Louisiana. That created a run on Eurodollars abroad and these correspondence banks. And then that eventually came home to roost in being unable to meet these obligations, that eventually set the 2008 crisis on its way. But in order to get the bailout, right, it's not like they said, yeah, we got to give a bunch of money to foreign banks, because people freaked out about how it was proposed as is, let alone if they just openly said, yeah, we're just going to give a bunch of money away to foreigners. So this myth of, well, we got to do it to keep people in their homes was created. And then you have, I love watching The Big Short as much as anybody, but that probably is not the actual reason why that went down the way it did.
Right. What for the people who are as retarded as I was, like, I don't know, a week ago, and don't know what the Eurodollar is.
Yep.
Do us a favor and give us a breakdown on that.
Okay, so this is important, especially for any, the Austrian school people. I love you guys, you're my people, but there's more to it than that, basically. And people get very fixated on interest rates, and the Fed and interest rates is what's totally going to dictate like the heartbeat of the economy. The thing is there's something called correspondence banks and dollars that are outside of the United States jurisdiction. Those are called Euro dollars. Euro just means like outside of the United States. It doesn't necessarily have to be Europe. And those correspondence banks do the same fractional reserve banking as here. And as long as there's not a bank run and they can meet those obligations, the illusion persists itself. And there's also the Trifflin dilemma. There's a permanent outflow of dollars because of trade imbalance. And basically we export our inflation because certain things have to be bought abroad in dollars. And the petrodollar is like this really classic example of that. So that it's that need for dollars outside the system. And I think what we're seeing now, the reason why we haven't had a taper tantrum like we did in 2018 or previous times that we've raised interest rates before. And even now everybody's like, oh, interest rates are high. They keep raising them. When are we going to have this crash? They're going to have to cut rates soon. Even in like very, very conservative TradFi circles, it's, they're going to have to cut rates soon. The reason I think why we haven't seen that crisis come to a head is because we also have this Ukraine war funding going on. And basically it's a great money laundering scheme to get, billions of dollars offshore through Ukraine to wherever it needs to go as aid or whatever. And that's balancing the books in the euro dollars abroad that we're not seeing a crisis here. I think they've kind of learned the lesson from the previous times they've done this, that they've got it worked out that, okay, as long as we keep subsidizing that system abroad, we can still raise rates here and try to control inflation that way.
This is really interesting because as I learned about this Eurodollar thing, what became obviously immediately evident to me was that this phenomenon means that the United States doesn't actually directly control its own currency. Mm-hmm. There's a significant leverage on the currency that's outside the realms of American sovereignty. And on the show here lately, we've been coming full circle on a lot of different characters. And one of the characters that I've been coming full circle on is the Fed, mm-hmm. because I've begun to understand now some of the thinking behind why they're raising rates and maintaining rates high, because of the downstream effect that it's having on Europe. And it's allowing the United States to begin reasserting sovereignty over the dollar. And then paired with, as Tom Luongo and Phil Gibson have
Yeah, he's
detailed,
great.
the move from LIBOR to SOFR has actually really has the potential to radically change the American monetary system, because now you have, as I understand it, essentially, again, a retard here, but as I understand it, essentially what SOFR does is it grounds the value of the U.S. currency in American economic activity, which then becomes something that you can game. You can actually game American economic activity, and the more American economic activity there is, the stronger the U.S. dollar gets, which then is going to draw capital from elsewhere. As Europe begins to fall, then you're going to get capital flight into the U.S., which then helps the U.S. rebuild the manufacturing and industrial base, which then allows the U.S. eventually to be actually able to assert itself as an imperial power. So putting all these pieces together, paired with the PayPal mafia general thesis, this is why I'm starting to think this is a really big deal.
Yeah. So I will say I'm not, the biggest expert in the Eurodollar system. People in the chat have mentioned Jeff Snyder in the Eurodollar University. He's really his dollar milkshake, or no, it's what's his name. It does dollar milkshake theory, but yeah, he's really the expert on kind of the Eurodollar phenomenon. Yeah, and like the PayPal mafia, whether it's a friend or Fed. Or whether it's just the enemy of my enemy is my friend. This whole war between private equity and the Federal Reserve versus the Treasury and this globalist regime, I don't know that either of them are necessarily our friends, but, if these two titans are fighting, that's probably the fallout is still going to be some benefit to us, as opposed to if they were collaborating together against us. And there's going to be leaky information that comes from that they're going to be exposing secrets about each other that otherwise wouldn't get revealed. Very much like, we have the domestic cathedral propaganda, and then there's Russia Today putting out Russia propaganda. And it's not that Russia is putting out, Pravda, literally the truth, but they're going to say the inconvenient truths about the Western regime, and then we're going to say inconvenient things about their regime. And somewhere in the middle is a reality that, maybe we can at least get the outline of what's going on. This quiet war between the different factions of the Fed and private equity and the Treasury and globalists, I think it's very much the same thing. It's also very reminiscent of the bond vigilantes in the 90s, especially now that interest rates are above zero, that you're starting to see some non-Treasury players start to be in a position to dictate terms or not give the Treasury a complete hand in controlling valuations.
So then where do we take it from here? What's the take it.
Yeah. So my self-serving interests, working in exit planning, the main thing my firm does is help, the smaller, what's called mid-market. So that could be anything from business selling from $2 million up to maybe about 200 million. Above that, you start to get into more of like that IPO or really high-end, big four kind of public or private equity. And then what do they do when they sell out? Who's going to buy their business? And then how do they generate income from that? I think, so going back to Michael Milken as well, how he did, he created the junk bond market and then helped to do that with leverage buyouts, that by being able for businesses to be able to issue bonds and rack up kind of private debt within the firm in order to take their position private. I think that's more of work, which is what Elon Musk did with Twitter. This is kind of this thing that in the 80s that maybe younger people don't even remember or haven't heard of since, but this used to be very common. If anybody's read or seen the HBO movie version of Barbarians at the Gate about R.J.R. Nabisco doing this, or any of those 80s corporate raiders movies like Pretty Woman or Wall Street, this is what they were doing. I think we're going to see more of that. And I think selling into that the private markets are going to be the new thing. So like even my own incentive, what I really do is help businesses not have to pay taxes when they sell is the other big part. If people just need to know they can wrap it up in a specialized kind of business trust. And if you're selling a business for 50 million, you can either sell it for 50, pay the capital gains tax and keep 30 while you write a check of 20 of that to Uncle Sam, or you wrap it up in a deferred sales trust and keep the full 50 million. But who you're selling to and how you're going to reinvest that, I think that's our opportunity for our guys to finally have our version of the Founders Fund to actually get money into our sphere to be able to even have businesses that are profitable, where that profits actually and competency is actually going to matter again. The businesses are smaller that a lot of those unlike a NASDAQ listed company that has to have one woman on the board, We could do things that actually where profitability and competence is actually the priority. And I think that's going to be the life raft, that as we see this liquidity cascade in publicly traded securities, and basically that system gets frozen in amber in order to take care of the boomers until they die off. Us, the younger generations who are going to have to survive that, it's going to be a pivot from this experiment with publicly traded markets back into private ownership like it was in the 19th century.
This ties in very closely with a lot of what we've been talking about with Jason at the 2-Bit podcast about building civilizational capital. Yep. And that, I mean, there's a lot of us who've come through this, libertarian to NRX to whatever pipeline. There's lots of theorizing. There's been lots of all kinds of different diagnoses of the problem, and we've parsed it out autistically from every possible angle. But the time has arrived. We're past the time where we need to begin doing things to solve some of these problems. And we're not going to be able to solve problems on the global level. We need to start working on our local individual areas, working on our protecting our friends.
Right. So that's a big thing for me too, is, instead of being so terminally online, there is a point of, I just want my friends to be able to afford a home, afford to date, afford to get married, and afford household formation of having children. And these autists have the technical competence to work in a role that would be profitable, that would actually counteract this great stagnation and would generate the profits to support all of that. But where most of that capital to make those investments is coming from is from that zombie capital world of IPOs and banking and the big tech or big corporations, and having our carve out. Now I'm still working out how to solve this. This is an open question. I would love for people to reach out to me and help me with this. Whether it is something like Michael Milken creating the junk bond market, there's many parallels to how crypto works with that. Obviously, there's also a lot of justified paranoia about rug pulls and a lot of shit coins. But some version of pulling that capital back into very similar, actually, how the Keiretsu or the Zaibatsu in Imperial Japan did this. Is it was the industrial concerns that actually made stuff, that made heavy equipment, made cars, made engines, that then were the free banks that they finance themselves internally through that. And that, the people who work there might bank with the company that's employing them because they know they're actually making stuff, and those profits can actually justify whatever the interest rate that they're getting by investing their capital in that firm. Something along those lines. The technical implementation, I'm working on figuring out what that would actually look like. But it's been done before, and we have design patterns that have worked that we can use as a jumping off point. Same way that, we're never going to go back, right? We're never going to go back to the 1990s or the 1890s even. But learning what worked in the past is going to inform how we can move into the future and create an alternative to the managerial regime. And I think looking at these other examples are good case studies for figuring out a way for competent people to organize capital and actually start doing profitable enterprise again. That also then justifies paying them well and letting them have families.
Yeah, starting a company is one of the most pronatalist things that you can do. I want to get back to this here in just a minute, but I want, for the sake of my own understanding, could you go into a little more detail on how the leverage buyout process works? I understand kind of the broad strokes, but get into the technicals of it for me.
Okay. And again, I'm not an LBO expert, but I'll give you the simplified version. Basically, somebody makes so the interesting thing about an LBO is that you're pledging the company that you're trying to buy as the asset for getting the funding to afford to be able to buy it. So that's kind of the trick in the 80s, and why it was very controversial at the time, is that the collateral that you're using to buy the business is a business that you don't own yet. Similar to how short selling works, that you get you promise access to shares that you don't own yet. And then as long as you have the shares by the time it comes due, you're okay. And the way they
is it almost like, so it's kind of like me going to a guy and saying, hey, I like your car, and going to a bank. And so it's taking out a mortgage on a company.
Right. So that's why Michael Milken with the junk bonds was kind of the big breakthrough. Is instead of having to go to a bank, which is controlled by our enemies, and they're going to say no, or, well, yes, but you have to meet these stipulations, or you got to go to this guy Epstein's Island, or whatever. He said, well, no, I'm just going to have the company itself issue the bonds. And he made a market in people buying them. There's some argument about how real those markets were, but there was a lot of legitimate interest. I mean, people were very starved for yield. It was an underdeveloped market. I think like 90% of it was legit. And considering how illegitimate kind of all Wall Street is, he's at least above average in that regard. And so the idea is, yeah, I'm going to sell all these bonds from the company. The company itself is going to be leveraged to the hilt. But all of the outstanding shares, they're going to make what's called a tender offer. So anybody can look at how Elon did this with Twitter. But if the market currently is trading Twitter stock for $60 a share, and Elon comes in and says, well, I'll pay $80 a share, that's what the tender offer is. And the corporations have to accept it because they have they're required by law to make money. So as long as they come to a number that they agree to, that's how a company reverses the IPO process. Instead of going public and receiving government stock in the form of Federal Reserve notes as like a stock swap, they trade it back. They say, well, I'm going to take the stock back and give the shareholders these Federal Reserve notes, and then you're able to take it private once you privately own a majority of the outstanding shares. So there's a mechanism for doing this, which I think most people, because you always hear about IPOs, but you don't really hear about LBOs anymore.
Okay, so people people in the chat are trying to keep up, and I'm keeping up. So
yeah, me too. I'm keeping up too. I promise.
I think the analogy is very instructive here. The analogy of a taking out a mortgage. So when you take out a mortgage on a house, you go to someone else and you say, hey, I like your house. I'd like to buy it. And you go to the bank and you say, hey, bank, I want to buy this house. Give me the money to buy this house. And the bank says, we'll give you the money to buy that house using the house itself as collateral. And then the seller then accepts that offer. But what's in this particular case, these publicly traded companies have an obligation. It would be like an owner that's obligated to sell the house when you come and make the offer to them, because they have a duty to their shareholders. So if you make an offer that's going to be financially beneficial to their shareholders, they're obligated to take that offer. So now they're essentially being divested from their shares in that company, and they're being reinvested in their shares in the United States corporation with the United States stock certificates or whatever that are the dollars.
And the other part to clarify there, so bonds 101, bonds are just a securitized version of debt or a loan. So instead of it being the bank giving you the money, you're selling bonds to investors, and that's where the money to borrow to buy that comes from. But otherwise, it's exactly the same.
The first place my brain goes with this is it possible, and has it been done before, to do a leveraged buyout of a country? Could you do a leveraged buyout of a national government?
So that's where, I mean, maybe that gets into like the territory of sovereign wealth funds. And at the same time, there is that, sovereign is he who decides the state of exception phenomenon. So, I mean, like if I were to investigate that, I'd look at how Saudi Arabia floated stock for their nationalized oil production. I think it's called Aramco or something like that. And because it's also a government, and it's a government that can do whatever it wants, by power of sovereignty, there's kind of a big debate of like, well, what are these shares really worth? Are you ever really going to get promised payment? Now, I think that also happens with, what we call private companies in this system, because it's a public-private partnership and it's never really private there either. The Mexico bailout is maybe another example I would look at to see how that would work. I think that's getting ahead of ourselves too. Let's focus on figuring out how to finance companies that get our friends houses and wives, and then we'll figure out how to take over other countries.
Yeah. That was more of a hold on a second kind of a moment. Caravaggio in the chat says Japan seems to have been able to resist the globalists to an extent. What do they know or do that we don't?
So I recommend anybody who really wants to do a deep dive on this. Richard Werner has been in Japan for the longest time, and he went through this cycle. They got paused after World War II, and then kind of again when the what is it? The Louvre and what was the other accord? Basically, like the United States screwed them on like interest rate exchange. They're in a similar situation. Japan's also kind of permanently 15 years or 20 years in our future. They're the canary in the coal mine. They're facing a very similar problem. The Bank of Japan has been, they're able to just straight up buy Japanese securities. That number is kind of crazy too. It's like I don't quote me on this, but it's something like 60 or 70% of Japanese businesses are owned by the Bank of Japan themselves. So it's much more nationalized than people realize. And a lot of that is like their version of the aging boomers who are dying off. It's to meet the obligations and promises that were made to them. And so that's kind of the horizon line we're all looking at, is what happens when the boomers finally kick the bucket and what does the system look like after the fact. But I think that transaction is going to be very painful for everyone involved. And what I would really keep an eye on, again, is that liquidity risk, is these things that you supposedly own and should be able to sell in a market. What happens when the liquidity isn't there to actually be able to sell? AGG is this bond ETF that in March of 2020, as the whole world was going crazy about, oh my God, is the whole global economy about to crash? This was a very, deep market, heavily traded, and it went untraded, I believe, for about a week because market makers just couldn't close that bid-ask spread. And for a major ETF like that to, if you tried to sell in that period, they're like, nope, sorry, we can't find any buyers. It's very similar to like thinly traded markets like over-the-counter pink sheet penny stocks. That's very much kind of the model I've been looking at as well, is how do people deal in those periods of illiquidity and what do they do about it? So yeah, at some point it's going to sort itself out, but I think that transition is painful, and that illiquidity of what do I do in those periods is going to be the most relevant question. And even like working with portfolios, modern portfolio theory again assumes that kind of like that markets are always going to clear. And there's all these examples where it's not the case. During the Great Depression, there's about 25 years where the market was always below or equal to whatever the buy-in was at the height of the stock market. Since then, there's about 2 or 3 periods where it was underwater for about 10 or 15 years. There's long periods where if you're depending on selling to generate income, you may not be able to sell. And my friend Daniel Paris, who recently wrote a book, The Ownership Dividend, which is great. And then where it really digs into this is his previous book, Getting Back to Business, which is, again, about basically what happened to dividend investing, how come people don't do it anymore, and why modern portfolio theory is bullshit. But there's like anybody who's ever gotten like the CFP or a CFA, because of M&M theory, there's this idea that capital appreciation and dividends are fungible. And this is always where in financialization people get in trouble. That similar sort of thing is why long-term capital management imploded. But there's this idea of, okay, if you have a share for $8 a share, and maybe it's going to pay $2 in a dividend, or it's going to go up to $10, up $2 from 8 to 10, that those are functionally equivalent. So there's no reason to prefer the dividends over the capital appreciation, except that the dividends come out of the profitability of the company, and the capital appreciation comes from that market making function. So if you're stuck with shares and you can't sell them, but they generate a dividend, okay, well, at least getting that dividend is giving you some liquidity that otherwise you're not going to be able to get if markets aren't actually able to clear. And there's just this widespread assumption that, oh yeah, well, markets are always going to clear, just like people always pay their mortgages.
Right. So I have a question about that. And I hope this doesn't like derail anything too far, but
no.
Okay, so boomers coming up on retirement, they're going to have to sell off, assets in order to have money.
Mm-hmm.
And they think, they've been saving up in their whatever pension or their IRA or 401k or whatever, and they think they're going to be sitting pretty. And then they go to sell, and nobody my age as a Zoomer is buying that shit.
Right.
What happens? Does it just collapse into nothing? And they're just left destitute, like eating dirt?
So that's the liquidity cascade.
Okay.
And like in 1929, we'll have a bank holiday. We'll do a reverse bailout like the Cyprus banks, right? I think what'll probably happen And again, this is speculation. As soon as I put it out there, of course, when whatever happens, it'll be different. But I would not be surprised if, based on how they've done it before, if it's something along these lines of, okay, everybody's tied to the S&P 500 index. The index is going to collapse unless we do something. We're going to create a special purpose vehicle that can then be owned and funded by the Fed or securitized by the Fed, that, you know, they're like the buyer of last resort. And then in exchange for keeping those valuations artificially high, in order to preserve the illusion of, oh, my portfolio is worth this big amount, and I'm always going to be able to sell off, you know, 5% a year in order to generate retirement income. It's similar to kind of how a lot of annuities work, where they give you a 10% free withdrawal rate, but the rest is locked up unless you pay a contingent sales charge, as like or like a CD, right? You know, it has a maturity date, and if you want to get out of it early, you have to sacrifice some of the interest that you would otherwise be paid. I think there will be some kind of gating, and this happens. There's a commercial real estate fund not long ago that did this. They imposed gating and like suspended redemptions, and people kind of freaked out. But the people who were in that, once markets settled down, they on a notional basis, like, you know, in terms of dollar amounts, they came out way ahead of all the other ones that allowed redemptions, and there was a lot of panic sales or like hot money flowing around. I think something like that will happen. You know, you bring up gating and people kind of freak out about that, but I think there will be something like an interval fund set up that the government will say, okay, we're gonna, you know, put a Fed put in this portfolio that prevents it dropping below a certain amount, but in exchange, we're not going to let you completely liquidate your portfolio and buy gold or something like that. So that's why I think the conversation worth having now for the kinds of people that have tens of millions of dollars in their IRA is, okay, well, you know, how important is that liquidity to you? Because that liquidity risk is the, you know, as soon as I say it's a black swan, it's not black swan anymore. But I think that liquidity risk is the piece that nobody's really looking at.
And so to put this in simple terms, the boomers who are retiring, they're expecting to basically be able to treat their retirement accounts like an ATM, where they just, you know, push some buttons and cash comes out. But that process behind the button pushing is, there has to be somewhere you're trying to sell stock, and there has to be someone there to buy that stock. And if people stop buying that stock, then you can't sell it. So then you're stuck with maybe not a worthless asset, but an asset where its value has now become completely indeterminate, because what someone's willing to pay for it is so far apart from what someone's willing to sell it for that it's going to take a while to figure that out. So the way the government is going to respond to this is they're going to say, we're going to ensure the value doesn't drop below a certain threshold. So you're not going to completely tank all of your wealth by leaving it here, but we're going to limit the amount that you can sell in a given year to whatever, you know, 5% or 10% or whatever. And so
it's like an annuity.
Yes, turning it into an annuity.
I think that's kind of what's good. And, you know, Social Security is an annuity. Social Security is basically forced purchase of treasuries that you can only annuitize. So, like, again, they've got this model down. It's just that bailing out this publicly traded securities, ERISA 401k IRA scheme, that's a big experiment with the biggest, most politically influential generation. If it doesn't work out, I think that's along the lines of how they're going to try to, you know, bail out the situation.
Okay.
So the CIPA is just for exit planning, actually. It's not like a CPA, it's certified exit planning advisors for. So one way to help fund our guys is getting that word out about that boomers who are selling a private business. This also works for commercial real estate. It also works for cryptocurrency. If you don't want to pay capital gains tax on that sale with less than 2 weeks of prep time, it can be wrapped up in a specialized kind of business trust called a deferred sales trust, so that you can defer those taxes basically in perpetuity. You know, anybody interested in this, we should have a one-on-one consultation. This is very much like the broad strokes of the mechanism. But 99% of financial advisors, M&A intermediaries, transaction attorneys, they don't know this is an option. And there's a ton of boomers who are paying a ton and millions of dollars in taxes that they don't realize that they have to pay. And usually their big concern is something called the value gap or income gap, that, you know, they're looking at how much money they're making off of their small business. Maybe they own a chain of dry cleaners or something like that. And they're looking at, okay, I'm generating this much money per month to fund my lifestyle. I don't want to make less than that after I sell, but I'm getting old. It's a huge stressor on my life. I'd like to start traveling or taking some vacations. How do I get out of this position and generate the same amount of income? But when they look at how much it's selling for, and as interest rates have gone up, the amount of money out there to invest has declined, although there's still a lot of money out there in private equity looking. I mean, there's way more people looking to place that private equity money than there are opportunities that are on the market to buy right now. But the thing that's really holding them back is they look at how much money they're going to get after taxes, where 20 to 40% of it is going to Uncle Sam. And they're like, well, that's not enough. So I'm just going to wait and see. And if they knew, oh, I can keep the whole thing and generate income from that, sometimes that's enough to close that gap. And they say, okay, now I'm willing to sell. And getting that kind of, that's that hard problem of getting money from the boomer generation to the younger guys by convincing them that they need to make this transaction. The other part that's kind of there to try to scare them, but it doesn't really seem to work, is, oh yeah, also if we have an economic collapse or another, the same way that everybody's worried about the lockdowns, valuations will tank. And there's even a problem with valuations that as they get older, I mean, I hear these stories of the M&A guys I work with where they're coming in, in a walker being like, okay, I guess it's time for me to finally sell. And it's like, they don't think you're going to stick around for a couple years in order to do the earnout, in order to teach the new owners like where all the skeletons are kept in the closet and like what all the issues are. Like there has to be some kind of transition period generally. And if they wait until the last minute like that, the value of the company is going to be a lot less than if they have that exit in mind for their business. So yeah, talk to your boomer parents about the need to do that planning, or at least put that idea in their head of like, well, hey, if you didn't have to pay taxes on it, would that change your decision?
So this whole idea here, not this specific idea, but in general, this notion, this has been something that's been very present on my mind lately, that we've got all these guys, all these young guys who are, drowning in their own autism, and they're by nature of them being in these internet circles, they're already indicating that they're like high IQ or have a particular obsession with complexity. These are all things, these are skills that can be sold for a lot. But, you get bogged down in philosophy and theory and everything, and then there's this spirit of, the theory cells where they just kind of sit back and they're like, oh, well, we know how everything works. We figured out all the problems and everything. It's like, well, then if you know how everything works, if you've already figured out what the future is going to be, then why are you not using that to make yourself immensely rich and make generational wealth for your children and build out your own communities? But now there's opportunities like this. This is a this particular angle that you're taking. If you then pair that on the flip side with teaching guys how to put themselves in a position to be able to buy companies like that, you've got boomers who are not selling, and everyone sits around complaining that they're not selling. Well, you're solving a problem that will make them more likely to sell. Well, now we need to be able to supply that market with buyers. We need to have our guys know how to put themselves in a position where they could take over a company like that. So this is, I think this is fantastic.
Yeah, that's exactly the problem that I want to solve, and getting the capital and the organization there to do that. Yeah, if you're so smart, why aren't you rich? And I know plenty of incredibly autistically smart guys who are not yet rich, and nobody's going. We're not getting those Teal bucks or Elon bucks. So yeah, if I can make that fund to get that done, I'd want to solve this problem, and it's solvable. It's just, so that's actually a great Michael Milken quote is, there is no shortage of capital. There's only a shortage of managerial talent. So it's not that, oh, there's not enough money to bootstrap these businesses. It's that you need a clever autist to invent junk bonds to generate the money to afford to fund these businesses or buy out these businesses.
This is part of what got me going on the so-called PayPal mafia phenomenon, was realizing I was starting to sort of develop a psychological profile for the types of guys that run in our circles. And then I was realizing, as I was starting to tap into these tech communities, and Gundo is one of the most prominent examples of this, but all throughout the Silicon Valley world are a whole bunch of people, a bunch of guys who are wired very similarly. They just happen to turn their obsessive autism into like software development or like building drones or innovating in like an entrepreneurial way versus it going down the theory cell way.
They go where the money is, and
Mm-hmm.
in hindsight, it's kind of shocked me how much. I mean, I'm the same. I started off in computer engineering as well, and worked for a .com that basically could have been YouTube. It was one of the like 10 companies that could have been YouTube. And then after the .com crash, went into finance because that's where the money is. And so much of it is tied up into financialization. And again, that's kind of the argument by Peter Thiel or even like Eric Weinstein of, okay, well, there's so many people just, manipulating numbers in a spreadsheet for this fake economy when they could be working in engineering problems or real problems in the real world and generating real profit to get us out of this slump. And so bridging that divide, especially kind of the Silicon Valley world, like when Silicon Valley Bank tanked, like they kind of know how that money system works. We need to be attractive enough in that like Alex Hormozy sense that it's impossible for them to say no in actually getting that money to us or inventing the system, whether it's some kind of crypto that does what junk bonds did or whatever that bootstraps the money to actually start buying. Because there's also kind of a faith problem, right? Like once you have somebody come in and he's actually cutting checks for hundreds of thousands or millions of dollars, it feels real in a way that theory cells don't, right? Like we could talk about it, but until it's actually paying the rent or paying my mortgage, it doesn't feel real to people, and they don't really have that emotional buy-in or loyalty until it's at that point.
Mm-hmm. Joshua Ham in the chat said, speaking of liquidity, who remembers when Robinhood wouldn't allow investors to trade GameStop stonks? The Zoomers remember. I doubt the Boomers ever caught wind or changed plans based on new info.
I remember. And
So the thing with that,
that was the last time I did any kind of stock investing.
And the thing with that is the casino, the house always wins in the Wall Street casino. And with Robinhood, what people, I get a free share. Well, there's no free lunch. Where does that money come from? And what people outside of this, there's like the dumb money and the smart money. And what people didn't realize is Citadel, who is the financiers behind that, was buying the order book of Robinhood basically to trade the opposite side of the dumb money. And that's how they got bound in that gamma squeeze. But the reason they're making money hand over fist is because they're looking, look at all these idiots and what they're buying on Robinhood. I'm going to take the other side of that. And outside of a gamma squeeze, which is very difficult to maintain in the long run, they're right. You can't win in that system. I think we need, and that's kind of like a version of voice. And I think we need exit more than voice.
So this has been one of the things within our, as we're building up within the Kingpill Discord server and starting to network out with other people who are like-minded. This has been one of the things that's most excited me is that there are these sorts of opportunities out there. There's the kind of, there's the opportunistic side of me that is attracted to it. And then there's also the side of me that feels like now that I have this knowledge, I have an obligation to go begin mobilizing myself and my people and as many other people as I can to start moving in that direction. There's gaping holes opening up in the market, but and this applies it like economically, socially, politically, all these different markets have these gaping holes opening up because the regime's entire premise has been a war on competency. And you can't sustain complex systems with incompetent people for long. They're going to collapse on themselves. The bet that the regime has been making is that they're going to be able to benefit the most from these collapses. You get into the business of generating black swan events, and you're the one that you get that kind of Cantillon effect where the black swan event is going to happen before the rest of the people know the black swan event's going to happen. So you can react to it quicker, and you can scoop up those resources yourself.
Yeah, the best way to predict the future is to invent it.
Right, exactly, yeah. So what we have now is we've got a bunch of people who are so tapped into what's going on. There's like people going around with black swan event generators. Or it's not generators, but detectors, rather. I love you, buddy. Okay. The bus is here? All right. Good night, little bus boy. So we've got a growing industry of black swan event generators. Now we've got a growing industry of black swan event detectors, which makes generating a black swan event less profitable for the person who wants to generate it.
Yeah, we're in the business of selling lifeboats, and the iceberg has already hit the Titanic.
Yeah, right.
So can I interest you in a lifeboat? But right now we have a bunch of people dancing on the top deck of the Titanic being like, nah, I don't need a lifeboat. And so uncorking that bottleneck of the boomers being convinced that, hey, you're not going to be young forever. It's not still Woodstock. You actually do have a finite lifetime. You have to have your day of reckoning of who are you actually going to pass this off to? And don't just wait until you're not here anymore to make that decision. And if we can take taxes off the table and you get to keep the whole amount of what your business is worth, does that change the equation for you at all?
So then you talk about creating like our guys' version of the Founders Fund. And this is, I've talked a lot with the PayPal Mafia, and with Jason, we've talked about the mimetic theory with Rene Girard. And one of the phenomena we're recognizing within this PayPal Mafia phenomenon is the mimetic effect that's happening with Elon and Peter Thiel, where they're kind of like the icons of the tech world, and everybody is mimetically identifying with them. Then you get the same effect now, where we can begin mimetically identifying with that whole coterie themselves. So they are all cross-invested with each other. They have all specialized, like completely cornered a whole bunch of different markets together and use that to build themselves up to where they can begin actually making a major impact on the broader world while also securing their own interests. And one of the major ways they did this was through through venture capital. So you have something like Founders Fund. Well, now we can behave sort of like a mini PayPal Mafia ourselves.
Some version of that. I also did a deep dive into, this is not the best example, but bear with me, pyramid schemes, and with Amway and the DeVos family. And they almost primarily funded the Reagan Revolution and getting, a slight right-wing reversal in the 80s by building up that capital from, they were able to crowdfund it. Now the big fad is with Reg CF, regulation for crowdfunding is kind of the current version of that. Now, obviously, they should have done it in a way that was actually profitable and sustainable and so on. But that money is there. It's just a matter of unlocking it so that we can create these efficient capital structures and get the autists to actually start engineering these things that actually produce value and get us out of this stagnation.
What do you think are the biggest things that are standing in the way of being able to unlock that?
It's a hard problem. Actually doing it and getting that inertia or momentum and getting people to believe in it and put their money where their mouth is, that's tough. That's very much kind of the problem that I'm trying to figure out. And it would be a lot easier if, it's the same reason everybody wants those Thiel bucks or Elon bucks. It's like, hey, at least, if I'm going to start, working for the counter elite, I got to find a way to pay my bills until, you got to have that VC runway until it takes off. And it is a long-term investment. What Amazon was unprofitable for like a decade, and people constantly mocked them, and now they're omni-consumer products, right? And they're billions of dollars and run everything. That kind of long-term time horizon and having low time preference, even on the right, it is very hard to find money and it's there. We know the same kind of circles of some hedge funds and private equity that are very much right aligned. There's a lot of energy exploration in Texas that's like that. Was the guys behind the Medallion Funds and Renaissance Technology are like that. But even they are stuck in this publicly traded securities mindset of, quarterly profits and short-term results. I haven't really seen the long-term version of that yield. And I'm happy to be corrected on this or work with people who are willing to take, year over year sustained losses because they know they're going to get that convexity event at the end. That's more they're going to pay for it. This is maybe not the best example either, but interestingly enough, during Japan's economic bubble in the 80s, that's how the anime industry got bootstrapped. There was toy companies that were flush with cash that paid the company that did Neon Genesis.
Matt, get him out of here.
Yeah, you can. It's fine. You could say. I just think as a business model, it's very interesting, worth looking at. You know, that they had like back-to-back failures where the movies that they made, they had like 2 or 3 stinkers in a row before suddenly they had this banger that is world famous and is this property that they're able to rent seek off of for like forever now. So that same willingness to have loyalty and stick with your guys for possibly some failures at first, knowing that they have that autism and that competency to pull it off at the end. That's what we're missing, is everybody bails too quick because egalitarianism and democracy causes high time preference, and escaping that generally is very difficult.
Yeah. So what you're saying is that our biggest problem, I'm going to put words in your mouth here. One of our biggest problems is that all of the people online who are spurging about the managerial class are behaving like the managerial class in their day-to-day lives. They are not actually investing themselves in the low time preference behaviors that could actually bring about a change in the general consciousness or the general direction of the country. And so it's time for them to put their money where their mouth is.
And it's also availability heuristic, right? So they just
have money.
They don't know. Yeah, so they don't have money. And even the ones that have money, they don't want to buy necessarily into real estate or publicly traded securities because, they're buying it at a high. Why would you buy high and sell low? Mm-hmm. And then the asset classes where they felt like they could get in on the ground floor has either been social media and being an influencer, which is a whole other set of problems, that we have the attention economy versus the real economy. Jay Burden and Oren did a great job on, Oren, I think, had a very pithy way of putting it of, I'd rather be high class than rich. That's a very pervasive problem. Mm-hmm. Or it went into cryptocurrency like Bitcoin. But again, we're back to that problem of people are just trying to buy into an asset bubble because that's what they see with real estate and stocks, and it's all based on money flows. What they're not doing is investing in CapEx. And this is why I really like the work that Richard Werner has done, is asset bubbles crowd out CapEx. It crowds out real investment in things that are profitable because there's risk involved and the results are slower. Mark Spitznagel's Tao of Capital covers this too. It's like fast growth versus slow growth. And that slow growth is crowded out by everyone's desire for fast growth that's not sustainable. And that asset bubble phenomenon of, cheap money flows going into, people who need the money now, the high time preference is what's holding back the real growth. And again, I think this is why we have this great stagnation or our version of the Brezhnev stagnation.
So where this really connects with a lot of the stuff we've been thinking about and talking about, some of it a little bit on the show, but more privately, is that if we do recognize that this is a problem, we do recognize this is now an opportunity, then as we begin conceiving of ways to go about taking advantage of this opportunity, it turns out that there's almost entire industries here that can be created. There's the opportunity to get on the ground floor of some things that are basically laying there waiting for us to take advantage of them, especially when it comes to organizing and coordinating people remotely. Obviously, you need to have the in-person, face-to-face relationship, and there's kind of part of the dynamic here is sussing each other out and figuring out, okay, what am I getting myself involved in?
Right. Yeah.
But I've said many times that I think that social media it's almost become a meaningless term because we're always social media. We just think of, when we say social media, we think, oh, Twitter, Facebook, YouTube, TikTok, LinkedIn. We kind of run through the list in our head. But I think there's if we're talking about digital mediums through which we organize socially, there is lots of untapped potential there. I think we're still very much in the infancy of that. And what this means broadly is that we now, I think the path forward is beginning to organize this way. I know it's already happening, but yeah, I'm beginning to get my foot into it and beginning to start building out networks of people who are thinking the same way, who each have their own projects that they're working on. And, I know you and I know you, and I know you're looking for this person and you're looking for that. And I can connect you guys together and we can begin cross-investing in each other and building out networks and becoming aware of different opportunities that exist out there and developing this sort of subculture of productivity and innovation and social networking among people who see the world politically the way we do.
Right. Yeah. So another model I've been toying with is the Chick-fil-A franchise model. They sell the Lord's chicken to everybody, but they are extremely selective about who they hire and who they let buy a franchise. And they've got a whole gauntlet that they put people through. I think a lot of that is kind of dispersion or misdirection for the real reasons of why they're trying to select for competency, let's say. They want the right people in those roles, but they're willing to sell to everybody. And not to throw anybody under the bus, but we see a lot of people on our side, they're trying to cash in or sell to our guys rather than invest in our guys. So it's a lot of buy these commemorative gold coins or buy these dehydrated food buckets. It's like, we don't have the money to begin with, let alone for us to be the cash cows to, for you to skim some money and then buy crap that's made in China. It's got to be the other way around, where we're selling something that's useful to everybody, that even our enemies are willing to buy what we sell. But then our friend group is who we keep in our circle of who works and owns those assets.
That's a really good thing to think about. I really like that.
I think ever since I did the show with Oren yesterday and then the one with AA on Monday, my mentions, the comments and everything, I've been getting feedback from people, the way people are hearing what we're talking about. And one of the things that I'm hearing repeatedly is people saying essentially that, oh, this is some variant of trust the plan. And that's the explicit opposite of what I'm saying when I'm talking about this PayPal mafia phenomenon. What I'm saying is I'm seeing people who are beginning to move in a direction where they could provide cover for us as we're beginning to try to set these sorts of things up. Because the domains where we could become specialists in managing social networks and investing and innovating and developing, whether it's in technology or there's these free private cities, the Free Private Cities Foundation, Charter Cities Institute, all these different ideas, these people are very much invested in those things as well. So there's a lot of common cause there where, I mean, it could even be as something as simple as just like trying to get them to invest in you directly, but even still, even not even going that far, recognizing that these are the domains that they are most invested in, which means if they're beginning to make moves for power and these are the domains that they're most invested in, then they can essentially function as a shield because they're going to want to protect their own territory. So then
they're going to protect their investments, getting that buy-in, getting that investment, and getting it based on competence and not just politics or hype. I mean, same with like Bitcoin, right? Are you buying Bitcoin because you're using it, or you're buying it because you bought in a hype? And a lot of people are buying it just because of the hype. If it was useful for Maersk to do cross-border payments of their shipping containers, suddenly that, and everybody in the finance space and crypto space, all the people I see here on Real Vision, Blockworks, etc., that's a theme that's universal is, oh, I wish any of this was actually productive or useful and not just a speculative asset. Like that need is really pent up, and we have the autists capable of doing it. And the investors are going to look for that real profit and that actual utility to invest in. But we've got to organize capital to actually be worthy of that investment. And I think if we put the focus there and prove that, hey, this is a good bet, that there will be some way to attract that capital or to create a structure that makes it more attractive to make those investments.
I just remembered something I was going to say earlier. You mentioned commercial real estate, and I work in real estate here in Texas. I've been in residential for the last couple of years, and I've started dabbling a little bit into commercial. And one thing that has made me interested in it was as soon as I began looking at commercial properties, talking to other commercial agents, I started recognizing a pattern very quickly. And I don't know if this is a Texas pattern. I don't know if this is a San Antonio and Austin area pattern. But like 95% of the commercial real estate agents that I see are men who are white, who are like 25 to 45. That's like 90 or 95% of the commercial real estate market, which is, and commercial real estate from an agent's perspective is much more profitable than residential real estate.
Right.
So these are the guys who are making the big money. compared to residential, which is about as diverse as you could possibly imagine across all different domains.
Yeah, the strippers and bottle service girls and models, they all go into real estate once they hit the wall. That's
Right.
kind of the universe. It's like, oh, you're good with people and you're charming. Okay, well, here's a job you could do in your 30s and 40s that involves the same skill set. The other side of that is my theory of that the idea of work-life balance was invented by feminists in order to hobble men that are otherwise willing to work 100-hour work weeks and will always outcompete women. And I imagine the reason you see those numbers in commercial real estate is because those are the autistic men willing to just make their whole life about selling commercial real estate. And that's all they do. And they do it 100 hours a day, every day, and all they think about. That's why it's them doing it.
Yes.
In general, there's always going to be outliers, but in general, women aren't willing to put in that kind of like autistic monofocus.
And even if you get like either a female commercial real estate agent or a white 35-year-old residential real estate agent, even comparing those like demographic equalities, the commercial person is going to be much more blunt, direct, to the point, not beating around the bush. And then even legally, commercial real estate is, I was going to say it's way more unregulated than residential. It's not that it's more unregulated. It's that it's differently regulated.
Yeah, in the investment world, it's accredited investors is the same thing too. So if you're investing over $1 million, or as an individual, you're making at least $200,000 a year, or as a household making at least $300,000 a year, a lot of the restrictions on registered securities stop applying, which is helpful because again, kind of going back to the money flows thing, if it's easy for money to get into, it all tends to synchronize based on money flows. That's kind of why like crypto hasn't been a really great diversifier compared to tech stocks, for example. They're highly correlated. Even bonds and stocks are way more highly correlated than people realize. A lot of that is because bonds start acting like stocks when the yields are low. But there's asset classes that are difficult to get into, even if you know they exist, like commodities trend following. How many people know what a CTA is unless they remember the 1970s and read Market Wizards by what's his name? Other than that, they don't even know that that's an option. And as a result, there actually is a uncorrelation between those two different assets because it's hard to get into. I forget where else I was going with that. Oh, the other thing I want to make sure before I forget with commercial real estate. So that same trust structure, if they want to avoid depreciation recapture, or they want an exit that is not 1031 until you die, or they're worried about 1031 rescue. 1031 is just a way that if you sell one piece of real estate and buy another, the government says you can roll over the capital gains into the new property so you don't owe a bunch of taxes when you sell, as a way to kind of keep the real estate market liquid, which is generally kind of an illiquid market. That trust structure also helps that you can recoup your basis, which is good because, when you're doing depreciation against it, when you're operating it, usually you want to be able to deduct those taxes as you're operating it. So yeah, that structure works very well for that as well, which is why I bring that up.
Yeah, the interesting thing to me about the dynamic within commercial real estate is
Jack Schwager. Yes, thank you. Yeah, the comments.
So in residential, I go through all the real estate classes and everything. They're mind numbing. And we spend probably 80% of the time in those classes, and continuing education and any sort of documentation is just covered with Civil Rights Act stuff, essentially. In commercial, so like steering in residential real estate is extremely illegal. But steering in commercial real estate is like a part of the job description. So there's a distinct lack of this is why I said it's not that it's not regulated, but it's regulated differently.
Yeah.
But it's regulated financially. It's not regulated like demographically or I don't know how to say this.
So yeah, there's a window of opportunity with it. Same thing with accredited investing. Same thing with CTAs. People working in finance, there's a big difference between whether you're RIA only versus attached to a broker dealer. If you're attached to a broker dealer, you're basically locked into using an ETF, and then people are using ETFs as the universal Lego bricks of somebody's entire portfolio. And if your portfolio is 100% ETFs, how is that diversified? There's other issues. The fact that's like a derivative asset and you get slippage and divergence risk and stuff that really nobody's addressing. People assume that ETFs represent the thing that they claim to be representing, and they don't, especially in periods of high volatility. So yeah, there's a lot of these asymmetric opportunities that we could be taking advantage of right now, like disruptive innovation, right? We could be the Uber or the Airbnb or whatever in the early years of like jumping into these things before the regulators realize, that for those kinds of people, it's not as onerous, and it's not meeting those political objectives. It doesn't have the eye of Sauron on them the way that the retail or residency markets do.
All right. Well, you got any more questions, Cooper?
No, I'm just letting the grown-ups talk today.
Yeah. I like CB in the chat here. He said, imagine working 100-hour weeks looking at warehouses. Imagine sleeping 4 hours dreaming in square feet. That's what the autism will do to you.
Yep.
All right, Sean, we'll let people know where they can find you, what your book's going to be called, where they can expect to look for that, and anything else you want people to know.
So the tentative title is The Sword and the Pillow. It'll probably be out around the same time that Gio's book is out. I'll make that comment. And I'm easy to find online. Sean Does It is generally my handle on most platforms. And I encourage people to look me up and reach out. And if there are specific issues that I can help with, happy to take that on one-on-one or just be a resource to you in this regard.
Absolutely. Awesome. Joshua Ham says, I want to know how I can work for Sean.
Let's have that discussion one-on-one. Reach out to me.
All right. And I'll put this out for anybody who's interested within the King Pill Discord server. If you like this conversation, if you like this this way of thinking, if you're interested in connecting with a community of people who is thinking this way and beginning to function as maybe a hub for these kinds of ideas, if you want to start developing your own social network and invest in building some of these communities, then we'd love to have you in the King Pill Discord server. If you'd like to join, for right now, the best way to get in is just go to linktree.com/kingpilled, and there'll be a link there that'll take you to the sign-up page. We'd love to have you. Thank you for watching. Appreciate you guys, and we will see you next time.